coming to pursue my MBA. So currently I'm on vacation where I'm having my summer internship in banking in New York, and I'm still doing project finance. So project finance is something I love, and I would love to talk to it. So let's start. Can you all see my screen? Oh, okay, sure. Yeah, so you start with introduction to project finance. So what at all is project finance? And how is it that project finance is gaining traction nowadays as compared to the past? So project finance basically is the financing of long-term projects, which is based on non-recourse or limited recourse financial structure. So what do I mean by non-recourse or limited recourse financial structure? So what it means is that in project finance, you are financing a long-term asset, and that comes with a huge capital intensity. So because of that, the owners, which you normally call sponsors, they are not willing to put in all the money. So they do that basically for two main reasons. The first is that it's difficult to raise that huge sums of money. And the second is about risk mitigation. So they don't want to put in all the money from their side alone, so that if something go bad, they won't lose alone. Because of the project finance is most of the time financed by equity and debt, with a chunk amount being debt. So because of that, the debt amount is so huge. And this debt that is coming in, we call it non-recourse. Non-recourse means that if something goes bad, the debt holders or the lenders, in this case, cannot go after the sponsors of the company, i.e. the owners of the projects, beyond the assets of the project and the securities they give and the guarantee. So the non-recourse means that your claims is limited to the assets of the company and any other security or collateral that was given during the structuring of the deal. So that's one characteristics of project finance that differs it from other financing. And how do we do project finance? So as I said, project finance always involves a project company. So the sponsor needs to set up a project company. And this project company is a special purpose vehicle. So it's a company different from the sponsor's parent company or other companies. And now this project company is a company that owns the assets of the project. And these are the assets that the lender can claim in case something bad happens. So basically, that's the definition of project finance. It's just the setup of an SPV that we call the project company, that the lender giving the loan for us to execute the project. In case something goes bad, this lender can take over this project to pay off the debts they gave us. And normally, they can't go beyond this project assets and any collateral that we give. When something go bad, they can't go after the parent company other assets if those assets were not part of the deal structuring, the collateral and the security. So basically, that's what project finance means. It's just the financing of long-term assets like roads, like huge buildings, those buildings you see in the middle of the cities, those tall buildings. Then energy assets like power plants, building refinery. Those are the assets we use project finance for. So that's the introduction. So we delve in, so we move on to the key characteristics of project finance. So what are some of the characteristics of project finance? What makes project finance different from other type of financing? So as I initially said on the previous slide, Project finance involve a special purpose vehicle, which is the project company. So anytime you want to venture into project finance, you set up a new company. That company will be the project company, and this project company will own the assets of the project. Then it involves a long-term investment horizon. So project finance normally is not a 1 year, 2 year asset. So let's say if you are importing goods from China to trade in Lagos, that's not project finance. You can't use project finance for that. So project finance normally is for projects that have a long-term lifespan. So like if you are putting up a hotel, if you are putting up, let's say, hostel facilities for universities, you are putting up a power plant to generate electricity, you are building, a government is building a road infrastructure. Those are long-term assets. The lifespan of those assets are normally more than 20 years. Those are the assets or the projects that we use project financing structure for. Then the third characteristic is what I talked about earlier, which was non-recourse or limited recourse financing, which I explained that it means that your claim or your right to claim as a lender is limited to the assets of the project company and any other guarantees or securities the sponsor gave. Aside that, you can't go beyond that and go. So if something go bad and even you see an asset of the sponsor is, let's say, the owner of the project. If you see another asset of that owner somewhere, and that asset was not used as part of the deal, you can't go after that asset to settle off your liability, your debt. No. So that's the non-recourse or limited recourse, the meaning of that. Then one characteristics of project financing is its risk allocation and mitigation. So what project finance does best is they look for the person who can handle the risk well or better and allocate that risk to that person. So in project finance, risk allocation is very, very important because the project involves huge sums of capital and also have a long lifespan. Risk is very important here. So you need to try and mitigate those risks, manage those risks. And these risks are allocated to people who can manage it well. So that's one characteristic of project finance. Identifying among the parties, the one who can manage the risk well and allocating that risk to that party is very important. Then the last characteristics here, but not the least, is the multiple sources of funding. So project financing can involve a lot of sources of financing because the capital sum you need for project finance is that huge. Sometimes you can even gather like 10 lenders, so 10 banks or 10 private equity firms or 10 fund, any source of funding. You can gather them like 10 and they will bring in the debt. Imagine you are putting up, let's say, $300 million refinery in Nigeria. Maybe one bank will not be willing to take that risk, putting $300 million in one project. Therefore, you need to find like 10 banks, and let's assume you divide it equally among them. That'll be 30 million each. Then everybody will bring 30 million to the table, and you get that 300 million. It can even happen that among these lenders, some will agree to be senior lenders, some will agree to be mezzanine. So the sources of funding these kind of projects can be multiple sources. So that's one characteristic of project finance. The structure you are putting together can involve various sources of financing. So these are some of the main characteristics or key characteristics of project finance. So we talked about project finance, but you and I know we are more conversant with corporate finance, because corporate finance is like the traditional form of financing that we all know. So then what is the difference between project finance and corporate finance? So as I said earlier, project finance normally involves non-recourse or limited recourse, which in corporate finance, it's not like that. In corporate finance, you have full recourse. So in corporate finance, you go with the balance sheet of existing company. So your company that you are in now, you use that company balance sheet to go and secure the debt or the loan. So in case something happens, the lender just come over and come to your current balance sheet and look at the assets and look at how they can retrieve their debts or their loan principal back from your current balance sheet. But in project finance, it's not like that. Project finance, we set up a new company. So this new company doesn't have a balance sheet. It's a new company. So we use this new company to set up the project. So till the project come to life, the asset this new company have is the project that we are building. So that's one difference between project finance and corporate finance. Corporate finance rely on existing balance sheet to secure funding, but project finance involves you setting up a new company. Yeah, so I will answer questions after the presentation. So if you ask questions and you have not been answered, don't worry, I'll take up all questions after the presentation. So the second point is about the SPV structure, which is the special purpose vehicle structure. So as I said, in project finance, you always set up a new company, which we call special purpose vehicle. And as the name suggests, special purpose vehicle. So it's a vehicle for a special purpose. So like if you set up the company for energy, for building a power plant, it's because of the power plant that company have been set up. That company will not go and do trading of importation of rice from China to Nigeria. No, that's the purpose you set up the SPV for. So the SPV structure is found in project finance. While in corporate finance, there's nothing like SPV structure because you are going with your current company's balance sheet to do the borrowings. Then one difference too is in project finance, we assess your ability to pay the loan. So the lender assess your ability to pay the loan based on the project cash flows. So this project you are setting up, okay, you said you are building a power plant in Lagos to provide electricity for the Lagos state. This electricity you are producing, how much are you selling it for? So what revenue is coming in? What are your expenses? After that, your profits. If let's say you have no receivables and your profits is equivalent to cash, so that's your cash flow, fine. If you discount all these cash flows to today, or even if you look at the cash flows across the amortization period of the loan, that is the lifespan of the loan, maturity period of the loan, and this cash flow each year pay interest and principal repayments fully? If yes, then I'm ready to give you the loan, because no bank or no lender, no financial institution want to give you money that you can't pay back, because every lender or every investor aim is to get their money back plus the returns. So if I can't get my money back, then I won't give you. So they mainly give you the money based on the project cash flows that we are envisaging that you can get from the project. But it's not like that in corporate finance. In corporate finance, it is based on company's balance sheet. So it's the current company balance sheet we are sending for the loan. So we are assessing based on your current balance sheet. So if your company is big, if you have a lot of assets now on your balance sheet, Then when you are coming for the loan, I can give it to you, because if anything go bad, I'll just step in, and because you use your current company, that's my security or my collateral. Then look at the assets and look at the one that can pay me off and just liquidate it. If it is cash too, I just take the amount that can fully satisfy my loan obligation you have towards me, and I'm off to go. But project finance is not like that, because you don't have any balance sheet. You are starting from a new SPV. You assess you getting your money back based on the projected cash flows from that project. So that's also one main difference between project finance and corporate finance. So take note of these differences. If you meet it anywhere, then we move on to the typical project finance structure. So how does a typical project financing structure looks like? So this is a typical project finance structure. You have the project company, which is the SPV we've been talking about. So let's say we are building a power plant in Lagos. The power plant is the project company. So that's the company owning the power plant, the plant that is coming to produce the electricity. So for you to set up this project, you first need contractors. So these contractors, when you are starting the project afresh, the first contractors you need is the EPC contractor, which is engineering, procurement, and construction. So the EPC contractors, they put together the projects. So if you are building a power plant, they will design, construct this power plant, procure the equipment. So if it is a gas power plant, they will procure the turbines and come and put up the project. So we sign EPC agreement with these contractors. So if, let's say, we are assuming we are the project company, we are the people putting up the project. So we own the project. We sign EPC contract with these contractors for them to deliver this project for us, to bring the project to life. So they are one party in a typical project finance structure. The other party is the lenders, which is very critical, because the lenders are those who give you the money. And as I said earlier, in project finance, mostly the debt is more than equity. The ratio is mostly like 70-30. Because of that, the lenders have more power, because they are putting in a huge amount of the money, a huge portion of the money, they are bringing it in. Because of that, they are very powerful, because they are risking a lot. They have the most skin in the game. Therefore, they won't allow you to do anything that you want, even though you are the owner of the company, but they are putting in more money than you. So lenders are very powerful. Then the next party is sponsors. So the sponsors, it can be one or it can be more than one. So they are the owners of the projects, the person building the project. So let's say there is a group, let's say ABC group of companies in Lagos, and they want to build an energy company. They will go and set up this project company to build this power plant. So the sponsor here is ABC group of companies. They are the sponsor. Then another party in project finance is insurer. So because, as I said, this is huge sums of money. This is huge project. So insurance is very important here. So insurers are also party to project finance structures. Then we have off-takers, which is essentially like the buyers, those who will be buying the products you are producing. So if it is energy or power or electricity, those who will be buying the megawatts of electricity you are producing. Then we have the government agencies, which they are very critical in project finance, because anytime before you put up a project, most projects, I will even say most happen on land. So whether you're putting up a building, a power plant, constructing a road, you use land. So mostly you need permits from these government agencies like the Environmental Protection Agency, like the lands commission. So those people, you need permit from them, because if you are going to construct on a land, you will be disturbing the biodiversity. You'll be disturbing the people living in the community if it is near a community. So you need permits from all these people, from all these government agencies, for them to be comfortable that the project you are coming to build is essential for the public good and is also not going to have adverse effects on the public or the environment. Then the contractors, if let's say it's a power plant or any other infrastructure project, especially in power plant, you call them O&M contractors, which is operations and maintenance. So you need operation. As the projects now start operating, you need those who will be maintaining the project for you. So there are also another group of contractors that we sign agreement with. So these are the main parties in a typical project finance, traditional project finance structure. And as you can see, the arrow shows each party, what each party brings to the table and what each party takes out of the table. So sponsors, what they bring in is the equity, because they are the owners of the project. So they will bring equity. The equity they are bringing in, their aim is also to get returns, which we call distributions, or in normal corporate finance, you call it dividend. So as a sponsor, as owner of a project, my aim is the project I'm bringing on board should make enough money or generate enough cash flows to pay off all other expenses and debt service and get access to pay me distributions or my returns as equity investor. So that's the hard portion. If you take the lenders bring you debts, which is, let's say, loan. The debts that they bring you in, they also expect debt service, which the debt service is basically the principal amount. So the principal repayment, you paying the principal sum they gave it to you earlier, paying it back and paying them the interest on the loan. So the interest and the principal repayment together is the debt service. So that's what they also expect from the project. Then the contractors, either EPC contractor or O&M contractor, what they expect from the project is their contract payment. You paying them the contract sum. And what you also expect from them is also delivering on the contract. So you also expect contract performance. They performing according to the contract agreements. Then when it comes to government agencies, as a project company, what you need from them is permits, them giving you the necessary permits for you to be able to put up the project. But sometimes, depending on the nature of the project and the jurisdiction you find yourself in, you can get grants from government agencies as well. So because most projects have that social good attached to it, normally you are able to get government grants depending on the jurisdiction you find yourself in. And sometimes we even, especially Africa like this, if our government is putting up project finance, like roads and those schools, buildings, hospitals, and those financing of project, they normally get some grant too from the multilateral agencies, which is the African Development Bank, the World Bank, Asian Development, those multilateral development institutions. We sometimes get grants if our governments are putting up some of these infrastructure projects because of the social benefits. So that's what you get from government agencies. Then what the government agency expects from a private project is paying of taxes. So when the project comes to life, let's say you build a power plant and now the power plant is producing electricity, you are making revenue. So anytime your expenses is lesser than your revenue, you end up making profits. That's the income statement. Anytime revenue exceeds expenses, it ends up in profits. So if you make profits, you expect to pay taxes on profits. That's the language of business. So it's taxes that the government used to run the country. So taxes is inevitable. As far as you're in a business and you make profits, you pay taxes to the government for the government to run the country. So these are the typical project finance structure. The off-taker, which is the buyers, essentially, they also expect you to deliver the product to them. So what they expect from the project company is to deliver the product. So if, let's say, you put up a refinery to refine crude oil, and I'm an off-taker or a buyer and I sign a contract with you, what I'm expecting from you is to deliver petrol, diesel, gas to me as a buyer. And as a project company, what I also expect from you is to also stick to the agreement you've signed. So in power or in electricity, we normally call those agreements power purchase agreement, PPAs. So if I sign power purchase agreement with you, as a project company, what I expect from you, the buyer, is to stick to this power purchase agreement and buy the product from me and pay me. Because the power purchase agreement means that we've gone into agreement that you'll be buying this amount of electricity from me. So maybe you say you buy 100% of my output, means when I produce my electricity, let's say my plant is 200 megawatt plant. Anytime I produce 200 megawatts of electricity, you need to buy from me. So that's what, as a project company, I also expect from you, the off-taker. So these are the various parties in the project finance structure. And these are the agreements and the obligation each expect from each other. And this is very critical in project finance, because for a lender to lend the money to you to put up the project, they want to see all these parties here and all these contracts, all these agreements. Because if any of this agreement is missing, it presents a risk. Each agreement here have a risk associated with it. So for example, let's take it that you don't have an off-taker. So you don't have a buyer you've signed a contract with. If I'm a lender, now what I'll be thinking about is revenue risk. That is, you are now going to sell on the OP market. So you normally in power or in electricity, you call it the merchant market. That is, you don't have a ready-made buyer. You haven't contracted yourself with anyone. So if you produce and nobody buys, you don't have anybody to go to. So it's like you cooking rice and selling it on the street. Every morning when you wake up and send and cook your rice and send it to the street, what you are hoping for is that people will come and buy. You don't have anybody whom you've gone into contract with that by force or by obligation, the person needs to come and buy. So therefore, it poses a risk that we call revenue risk. Like, what if tomorrow you don't get anybody to buy? How can you generate that cash flows to come and pay back my loan? But if you have someone you sign a contract with, that person is obliged to take your product, it means that anytime you produce, even if the person doesn't take it. So normally in Africa, like this, most of our, if I'm using the power sector, for example, most of the contracts our government signs with this independent power producers is what we call take or pay. Take or pay means that if the power plants produce the electricity and the government doesn't take that power output that has been produced by the producer, the government will still pay the power producer. So if you present a contract like this to a lender, the lender is very comfortable to lend to you because the lender knows that you have a guaranteed cash flows coming from somewhere, which you use to pay my loan. So that's why each party is very important. So anytime a lender is doing risk assessment before they give you the money, they check all these parties and check that everybody is playing its role as they need to. So that's a typical project finance structure you find in a typical project financing. Then the next we will talk about is risk allocation and mitigation. As I said earlier, in project finance, risk is very important and very critical because of how project financing is. The money going in and the lifespan of the assets and the road the asset is coming to play. So risk is very important. Risk management is very important in project finance. So how do we manage risk? So one thing project finance does well is allocation of risk, i.e. allocating risk to the various parties involved in the structure. So normally you allocate the risk to the party in the structure that can manage that risk well. So for example, these are some of risk in project finance, and these are the people that we assign, the parties that we assign those risks to. So if you take construction risk, that is any risk associated with the construction, we normally assign it to the contractors because they have the technical capabilities to manage those risks. So we assign it to them. We sign a contract with them, and this contract has risk mitigant strategies like you signing what you call bond. So we have completion bond, which is like a form of insurance. That's it. So as an EPC contractor, if you don't complete this project at this time, these are the penalties, or these are the compensation you need to pay to me as the owner of the project. We have what we call liquidated damages. That if you don't, we have what we call performance bond. If that means if you don't perform up to the specification, the standard both of us agreed in the contract, this is what you'll be paying. So we try to allocate this risk to the person who can manage it well, which in this case is the contractor. So when it comes to the operational risk, we allocate this operational risk mainly to the project company, which this project company also have. If it is like power sector like this, they also have a contract with a contractor that we call O&M contractor, which is operations and maintenance. So they will be doing the operations and maintenance. Let's take market risk. So market risk is you not getting a buyer for your product. So how do you manage this risk? That is, if it is power sector, we signing PPAs. That is power purchase agreements. So let's say even if it is a hostel, what can you use to manage a risk like this? If I build a hostel near to a university campus, what I'll do is that they will sign a contract with you, the student that's coming to sleep in. Let's take a typical, like for example, a typical African university, most of the time they even take the rent for 1 year that you are staying there. So they take it in advance. So they have the cash flows in advance. So it's like they've already sold the product, even though the product has not been delivered yet, but they've already even taken the cash from that product already. So this gives a lender comfortability that, yeah, you have a market for the product. If you take power, you have the power purchase agreement, the PPAs. That says that someone has agreed to buy the energy I'll be producing. So that gives the lender comfort that you've allocated this revenue risk to someone. Let's take financial risk. The risk that
I can see your slide. I can see.
Oh, okay, sure, thanks. So let's take financial risk. Financial risk is the risk that interest rate is going against you. If you are using other complex financial instruments like those hedging instruments, swaps, and those things, how are you managing those financial risk? Because let's say if you get a fixed income loan, let's say a fixed interest rate, fine, you will be paying that one fixed throughout. But let's say you go and get a floating interest rate, which now your interest payment is subject to the changes in the interest yield curve, then how are you managing it? Are you going to enter into hedging with a financial institution and transfer that risk to that financial institution? So if so, then those are the people who can manage it well. So you assign that risk to the financial market for them to manage that risk for you. So a lender will look at it and see that, is there any financial risk associated with this project? And how are you allocating this financial risk? Whom are you assigning to? And the best party to assign this to is the financial market, because they have the technical ability to manage financial risk. Then you have political risk. So political risk is like something going bad politically. So for example, if I build a power plant in a country and tomorrow there is uprising or there is a military takeover in that country, what will happen to my assets? Will my asset be seized? Can I still operate my assets? Or if I even signed a contract with the government of that country to buy the electricity from me, and tomorrow, let's say there is a change of government, will that government still stick to the contract I signed? If there is a military takeover, will the new military government stick to the contract I signed with the previous government or not? Or if tomorrow there is an uprising and people start destroying properties in the country, so how do you mitigate political risk? So you need to assign it to, so normally you assign it to the sponsor, which is the owner of the company. Then this owner of the company will now go and assign it to insurers. So there are agencies that also gives that guarantee in terms of political risk, that if something happens, we will step in and pay you. So this then give comfort to the other parties in the structure. Then we have environmental risk. That is you not doing anything that will harm the environment, or doing something that will harm the environment, that will come and harm the project. Like the community standing up against you, that because of maybe you not disposing of your waste well, we are standing up against this project. If they stand up against this project and they destroy the property, or they take over the property, or even they boycott that property, the products coming from that property, where are we going to even get the cash flows to pay minders? So as a lender, I also look at how you are allocating your environmental risk. A government will also look at it, because if anything goes bad environmentally and affect the public, it's the government responsibility to step in. So because of that, they won't even wait till you make something go bad. So they always, the government agencies, and that's why you need permits before you even put that project. And after you put out the project, they will be even coming in regularly to check if you are going according to the environmental standards they gave you to adhere to. So these are some of the main risks in project finance and the parties we are assigned to in the project finance structure and how they manage it. So we move on to the sources of funding, which is a main thing in project finance. As I said earlier, project finance involves multiple sources of funding. So mostly, these are the typical sources of funding you see in project finance, in a typical project finance. You have the equity, which is coming from the project sponsors. Then we have the debt, which is coming from the lenders. Then we have what we call mezzanine financing, which is typically a hybrid of debt and equity. So they sit in between equity investors and debt investors. So the debt people here are senior debt holders. So they normally call them secure lenders. So if anything happens, they are paid first. Then Now we come to the mezzanine financing. So they are also debt providers, but they take a hybrid form. So even some of their debts, they can agree to convert it to equity at some point in time. So they take on a higher risk than the debt holders. Because of that, they also expect to get a higher returns than the debt holders. Because in finance, the higher the risk, the higher the returns. Then we have export credit agencies, which are mostly like owned by government or intergovernmental organizations. So example of some of these agencies in Africa is like the Africa Export and Import Bank. So in Ghana, we also have Ghana Exim Bank, which is Ghana Export and Import Bank. So these agencies also sometimes provide funding for projects, especially project that has exports like nature. So project that will be increasing export or decreasing import. Like they normally fund those projects as well. So let's say you are building up, let's say, agro processing plants that will help process agriculture products and reduce export or reduce import or increase export. You can apply for loan from these credit agencies and they will also fund the projects for you. Then we have government grants, which I said earlier, that sometimes if the project have that social benefit or social good, sometimes the government of the day can give you a grant, like, you don't pay back grants. So it will be like a form of equity into the project. Then we have the multilateral agencies, which is World Bank, Africa Development Bank, and they are private arms like the IFC, the Africa Finance Corporation. They all finance projects. AFC, they all finance projects. So those are the sources of project financing where you normally raise funds for project. Then we move on to the project itself. So when you are doing project finance, one thing that's very critical in project finance is financial modeling. So financial modeling is very important in project finance because, as I said earlier, you need to project the cash flows that will come from the project. And we do that through financial modeling. So financial model essentially means you are predicting or you are projecting the cash flows that will come from the project in future. So you are putting on a spreadsheet the revenues that will come and the expenses that you will make in operations and the amount you need for construction, then getting your profits, then out of this, getting your cash flows and matching these cash flows to the sources of funding that you are using. Can these cash flows pay the debt and get excess returns for equity investors? So essentially, that's what the financial modeling does. The financial model just shows the projection of the cash flows, essentially. So it's very important in project finance because that is what the investor is, let's say, is one of the documents, one of the critical documents the investor assess to know whether to invest in this project. So it comes with a lot of scrutiny when you prepare it and send it to an investor. So these are not the main things you normally see in project finance, financial model. You see your cash flow projections, then the investor will carry on sensitivity analysis, which you, the project company, can also do some on your own to see how robust your financial model is. So the cash flow projection is what I talked about earlier, getting your revenue and your expenses and arriving at your cash flows. The sensitivity analysis is about you taking some critical inputs of the model and subjecting it to, I would say, stress testing. For lack of better, let me use stress testing. So what it means is, let's say you projected that when you are doing your financial model, you use that GDP growth will, let's say, be 4% yearly in Nigeria. Because of that, the demand for your goods, or let's say if you are building a power plant, you say, okay, because of that, then this is the amount of energy that will be required from me. Because as GDP grows, you need a lot of energy to power the economy. The sensitivity analysis goes that, okay, what if tomorrow GDP is 1%? What happens to the cash flows you've projected? So the initial cash flow, you normally call it your base scenario. That's the base. Then we now suggest some of these critical inputs. So your revenue growth, the assumption that you used, because nobody knows the future. So everything you are doing is assumptions. The backbone of the financial model is the assumptions that you are making. So if you assume that your revenue will be growing at 3%, 3%, okay, what if tomorrow your revenue is growing at 1%, 1%? Can the cash coming from the project still pay the investors? So that's the sensitivity analysis part. The scenario analysis, just like sensitivity, just like scenario analysis, look at scenarios. Okay, let's see if tomorrow this happens. Let's say tomorrow this happens and oil prices increase. It will increase our fuel cost, which will increase our expenses. What then happens to our cash flows? So those are the things you do to know that at the worst case, what are the cash flows that we getting? Are these cash flows still able to support the amount of debts or funds we want to raise? Then we have what we call debt service coverage ratio, which is one of the financial ratios that is very critical in project finance. Because this is the ratio that the lenders use to determine the amount of debt they should give you. So if you take debt service coverage ratios, those with accounting background, this means your EBITDA, normally we use our EBITDA over the debt service, because you normally use the EBITDA as a proxy for cash flow from operations. But what this means is that if you pick your cash flow from operations and divide it by your debt service, what ratio are you getting? So debt service is the interest you have to pay in that period, plus the principal repayment you have to pay in that period. If you add those two together, that's your debt service. The cash flow coming in that period, how many times does that cash flow cover this debt service? So if your debt service is 100 naira and your cash flow is 100 naira, the DSCR, the debt service coverage ratio is 1. So that one means that your cash flows is able to cover your debt service one time. So it means if anything happens, you can't cover my debt service. So as a lender or as an investor, I always want a debt service coverage ratio, which is a little bit above 1. That is, if you pay my debt, you also have some excess cash flows remaining. So that in case something happens, I'm still comfortable that we will still get my cash, my debt repayments and my interest repayments back. So the debt service coverage ratio is what in financial modeling is what we used to, lenders used to determine the amount of debt they should give it to you. So they call it debt sizing. They use that one to size the quantum of debt they should lend to you. Then internal rate of return, which is very common term, is a return which is, we do it internally. So is the rate of return at which the NPV of the project is equal to 0. That is it. It is the rate at which the project cash flows, the present value of the project cash inflows, equal to the present value of the project cash outflows. So the IRR is very important, because if your IRR is greater than your cost of capital, then it's a good investment, all things being equal. Because what it means is that the returns you are getting is more than the cost of the capital you are using, which is the cost of equity, cost of debt, and other forms of capital put together. We call it cost of capital. So it's also a good metric or critical metric in project finance. Then finally, you have the net present value, which we all know, the NPV, which is the present value of all future cash flows. If your NPV is positive, then all things being equal, this project is worthwhile to invest in, taking all other factors into consideration. So these are critical metrics and ratios that in project finance modeling we normally take into consideration or work towards it. So then we move on to challenges in project finance. So in project finance, as I said, even looking at these parties involved, there will be some challenges there. So one of the challenges is the complex financial structures. As I showed you earlier, the parties involved are many, and the financial structure we put together can be so complex. So sometimes the parent company will set up a new SPV, and that new SPV now become the investor, equity investor in the project company itself. So you can have a holding company, then you can now have a sub-holding company, and that sub-holding company will now come and invest in the project company. Even the debt that we put in, the debt can come from many sources. As I said, some can come and secure debt holders, senior secure debt holders. Some can come in as mezzanine. So the financing structure can be as complex as you can envisage. So when it becomes like you need to dig deep into it to look into the structure and ascertain things as an investor to know that you are comfortable with this structure. Then you can also get market volatility, as I was saying. If you don't have, let's say, if it is not a power plant, let's say if you are putting up a hotel and you don't have already made customers, and tomorrow something happens, let's say the time we had the COVID, people were staying home, nobody is going for conference or meeting. So if you have a hotel, you have a low occupancy rate. How then do you generate the cash flows to pay the debts? So the market volatility, you can also take it from the side of the financial market as well. If you don't hedge your interest rates, and in case the interest rates yield curve starts fluctuating, how are you going about it? So those are some of the challenges we try to solve in project finance to mitigate. Then we have the regulatory hurdles. So the regulatory hurdles is able to maneuver through to obtain the necessary permits and regulatory clearances to put up the project. Because most of these projects, as I said, is constructed. So it involves the land and all those environmental activities. Therefore, you always need to engage the regulatory bodies to obtain the necessary permits. And some even take years. Some permits, they need to do a lot of assessment to see that this infrastructure project you are coming to put here is good for the public. It won't bring any public harm. So it can take years. Some even you face legal challenges in courts, like some communities can say they don't agree and all those, that you need to do all this before you get the clearance. So that's also one challenge of project finance. Then as usual, the political risk that I explained earlier. So what are some of the best practices? Since these are the challenges, so the best practices, number one is thorough due diligence. So before lenders give you their money, they will do a thorough due diligence to see that they are very comfortable with this project and everything about the project. Have you obtained the necessary permits? Have you signed your PPAs or your product, if it is not power, if it is any other product, agreement that you have customers who will be buying, or do you have a reliable market? Even if you don't have an agreement, is there a reliable market that you think they will buy this product? They will do all the due diligence, where the equity is coming from. Are you putting in the equity? Who is the EPC contractor? What's the track record of that contractor? Have they developed that project before? If not, do they have the necessary technical know-how? Who are those leading those EPC company? Like, they do a lot thorough due diligence. They bring in independent consultant to also come and put their view on the table on each part of the project, for them to now know that, say, okay, I'm now comfortable to put my money into this project. Then the financial modeling I was also talking about earlier, that's also one best practice, subject the numbers you are bringing to stress testing, quote unquote, to know that truly this project can pay back their money. Then the effective risk management I talk about, which is you allocating the risks to the various parties that can manage this risk well, so that you'll be comfortable with the risk that this project poses. Then the last part is strong stakeholder engagement. As I said, most of these projects, you build it on land, so it can happen that the project is near a community or not. So you need to engage all these communities. You need to do strong stakeholder engagement to let them know the benefit this project is bringing, how you are also mitigating the risk this project poses to the community and the environment. So these are some of the best practices that we do in project financing. So in conclusion, what I would say is project finance is a critical tool for financing long-term assets. Therefore, as a finance professional, you need to know the key characteristics, the structure and the risk mitigation strategies that are used in project finance, especially if you want to pursue a project finance career. And even if you don't want to pursue, as a finance professional, knowing a bit about project finance is very important and very essential. So I'll end here and move on to questions and answers. So thank you so much for your engagement, and feel free to ask any question that you have. Thank you.
Thank you very much. Thank you very much for your time, Mr. Frederick. But before then, people in the YouTube class, the attendance link has been dropped on the group chat and it's closed by 6:30. Also, Akitpelu Ima and many other people, can you help me confirm that you saw his screen from the beginning of his session till now? If you saw a screen, can you just like do a thumbs up? Because some people had issues with seeing screen, and I saw a screen. Yeah, Tobina saw the screen. Emmanuel Wisdom, Ishak, can you see now? So if you always have a screen issue or you can't see the slide, it is your network. I can see the screen, and many people have confirmed that. So please, going forward, if you can't see the screen or you can't see slides, it is your issue. As long as I can see it, it is fine. And people have also confirmed that they can see it. Thank you. So if you have any questions, we have some questions in the chat box. Let me just do a quick check from the YouTube class if we have any question. However, if you have any question that you want to speak, I want to say it out verbally, you can just raise your hands. I'll call you. Yeah, a minute. Let me just check the YouTube class if you have any question. Okay. So let me just start from the ones here. The one that it might be so loaded. Okay. So someone says that he gets lost when he hears recourse and non-recourse. So like, can you just give the
Yeah, so When you say recourse and non-recourse, recourse means that I can come. So in literal meaning, street language, on the street, recourse means that I can come after you for my money if the project goes bad. So let's say if the project collapses or things doesn't work as envisaged, and we don't get the money from the project to pay back my loan, I can come after any assets that you have for my money. But in project finance, it doesn't go that way. That's what project finance is, non-recourse. Non-recourse means that in case anything goes bad, you getting your money back is limited to the asset of the project, and any other assets are used as collateral. So if in the agreement, in the loan agreement, I didn't use, let's say, my current company head office as collateral, if something goes bad, you can't come after the head office of my current company. You just go after the assets are used as collateral and the project assets for your money. So that's the non-recourse. So recourse is simply means going after someone for your money, or that's the street meaning, like going after other assets of the person, of the sponsor for the money. But in project finance, you getting your money is limited to the asset of the project, and any other assets are used as collateral. But in corporate finance, I will just come after the asset on your current company's balance sheet and sell off and get my money. So in corporate finance, there's recourse because you use the existing company to borrow. But in project finance, there's non-recourse or limited recourse to the assets of the project, and any other assets are used as collateral.
Okay. Yeah. Thank you very much for that. So another question, it says, does the SPV wind up once its purpose has been achieved? Like when the project has been concluded, does the
Yeah.
SPV wind up?
Sure. So when the project is completed, the SPV now become operating company. So let's say we were building an energy plant, a power plant in Lagos. Let's say the name of the project was Lagos Energy Incorporated or Lagos Energy Limited. When we are done with the power plant, now the power plant is operating company, so it becomes just like any normal company. So the SPV now turns into operating company and becomes Lagos Energy Company Limited, as we know, the Lagos Energy Limited. So this company will operate to the lifespan of the asset. So let's say a power plant has a useful life of 30 years. If nothing happens, then this company will operate for 30 years. If after 30 years, we don't build another power plant using the same company, then this company dies off. But if you put up another power plant with the same company, then the company also keep on going again. So after the construction of the project, in summary, after we bring the project into completion, the SPV now turns into an operating company, just like any other company.
Okay, thank you for that. So another question says, do you know like a list of firms in Nigeria that does project finance? Do you have an idea? Or
Yeah,
could actually
so
like
I know of the African Finance Corporation in
Okay.
Nigeria. I know, yeah, they are more into project finance. So, and there are some private funds too, like private equity funds, like fund managers, impact investors who also invest into project finance, who some are located in Nigeria, but I don't have the names off head, but you can research. You just type on Google financier, project financiers in Nigeria, or company or lenders financing projects in Nigeria and Africa. The name will come. Or private equity investors investing into projects in Africa. You get like tall list of names.
Okay. So thank you. Somebody
Sure.
else is asking that when one is trying to like bid for a loan, is it just the balance sheet that is submitted? Wouldn't there be any any form of physical verification of those assets?
Won't there be any form of
Physical verification of those assets, like
yeah? So
physically verify those assets.
yeah, thank you for that. So that's the point I raised when I was talking about the best practices, the thorough due diligence. So verification, so the monitoring or the verification of the physical assets, physical existing of those assets are all part of the due diligence. So they normally cut it short, DD, due diligence. They go and verify. That's even corporate finance. If I'm an existing company, I want to use my balance sheet to borrow, and I tell them I have this head office in Lagos, I have this branch office in let's say Port Harcourt. The bank will go and verify to see. They will take papers, legal documents to verify that truly this company is the owner of these buildings before they lend to you. So they call it due diligence. They do all this before they give you the money. They just don't wake up and give you no, they don't do it that way. So that's the due diligence I was talking about. It's part of it.
Yeah. I think in deals also, someone actually spoke to us on due diligence when we had the deals advisory session. Okay,
Sure.
thank you for that. So the next question, someone says, how is the cash flow measured in terms of the inflow? Let's
Sure.
assume, okay, let me just
continue.
yes. Let's assume the expenses is 100% accurately captured. How do we accurately measure for the inflow?
Sure. So if I get a person so
Okay.
what we do is the revenue. So you have what you call the inputs, and these inputs most part is based on assumption. So we will assume that sometimes based on historical record or based on industry numbers. Let's say you are putting up a power plant or you are building a hostel facility near university. You assume based on current pricing that they charge each student for the existing hostel facilities in the university campus. So maybe based on that, you can estimate your own fair price. So let's say currently they charge, let's say 100,000 naira. Then I say, okay, then I also charge 100,000 naira. Then the hostel I'm putting up, the rooms are how many? So if I have 100 rooms, then all things being equal, so that's the base case scenario. I'm assuming that 100 rooms will all be booked. So I will have 100% occupancy rate. Then I multiply that 100 by the price, which is 100,000 naira. Then that gives me my revenue for each month. Then I now come and consider my expenses. So the expenses is also an estimate. All this we are doing is an estimation because we are just projecting the future. So that expense is also based on past data. Either you have a hostel somewhere that you're operating now and have actual expenses, or if you are new in the game, the expenses of the existing players, the existing hostel facilities, what are the common expenses? Then we put all these expenses down and also project it into the future by growing it. Sometimes use the inflation rates to grow it. So you do all these are all assumptions. Then you also get the expenses. Then now come and deduct, then you get your profit or your income. So it's this profit that we now turn around to get our cash flow based on cash flow statement. So let's do simplistic analysis that we don't have receivables. So we, as we sell, we get our money. So nobody owes us. We don't sell on credit. Then that in that scenario, your profit now turns into cash flows. So this cash flows is what the lender is now coming to look at to see that can this cash flow pay my interest and my principal repayments? Because if you give a loan, let's say for 10 years, because something amortization, normally we divide this loan over the 10 years. So if I give you 10 million naira, every year you need to pay me back 1 million naira with then in addition to the interest. So when you add the interest to this 1 million, that gives us the debt service. So the cash flow you are getting should now be able to cover this debt service and even have some small margin of excess depending on the lender preference, maybe like 20% excess before I will even give you that loan.
Okay. Thank you for that. So let me take some questions from our YouTube class before I continue here. So on YouTube, someone says, what's the maximum number of parties that can be um involved to fund a project? Like, you said that it can be one company and it can be like many companies come together to fund a project. So what's the maximum number of
Yeah, so
companies
there's,
on the
yeah,
project?
thank you for that. There is no thumb rule for like a maximum number. It depends on the project and the
Project that
parties interested in it.
mhm,
But what I presented was like a typical structure. So, like the financiers, the lenders, you can have a project and there's only one lender who is
mhm,
bringing in the money. But it can be a project. Let's say the project is, let's say, $300 million. Maybe one lender is not comfortable taking that huge risk. So that one, we need to bring in a lot of lenders.
really,
We have
yeah.
like five, six
Sure.
lenders. Exactly.
Yeah, thank you. So someone else says, when when preparing the financial model for the company's new product. Okay, now let me just explain this question. Now, this company has no financial statements. What financial data can be used to prepare the financial model? So, like, a company now wants to like get finance, but it doesn't have a financial statement, maybe probably a startup and all. What data can be used to prepare the financial model?
Yeah,
That's
so that's what I was explaining earlier. In project finance, there is no past financial data. Like, it's a project company, so it's greenfield. Like, it's a new company mostly in project finance. They are greenfields projects. So all what we are doing is estimation based on
estimation.
industry and based on, let's say, if the company owns another power plant somewhere, then the data from that power plant. So if I'm operating there, the expenses I incur, the revenue I get from it can be a guide. But the new company I'm putting at the new project, the SPV, there is no past financial. So what we are doing is, if I've signed a power purchase agreement, PPA, that I will sell maybe 1 megawatt of electricity for 10 naira. How do I get my revenue? I'll just multiply that 10 naira by the amount of energy I project producing each year, and that gives you my revenue. My expenses will based on, I can go and look for industry data, which companies are now producing power. What are the expenses they incur? How salary they pay the accountants, engineers, cleaners. Like, I put all together, then I get my expenses. Then I arrive at my profit and my cash flow finally. So there is no existing financial statement for the project company. So it's not like you are picking a financial statement and build it up from the no. We use input from what we envisage the revenue from the project will be and the expenses we expect to incur.
Okay, thank you. So Kron says, what are the examples of penalties that can be placed on financial risk? What like penalty can be attached like
So,
in the financial
so
risk?
at the end of the day, if I understand the question well, when it comes to financial risk, if you don't manage it, and
Yeah,
I'm
what
a
are the
lender,
penalties?
yes, I'm a lender, and I maybe forgo about that and give you the loan. At the end of the day, the last penalty or the ultimate penalty is for me stepping in. If you default, let's say you didn't, the interest was floating interest rate, and you didn't hedge it. And now the interest rate curve maybe has gone up. And because of that, you need to pay a lot of interest and you can't pay. as a lender, I just step in and take over the company, the project assets, and either manage it and pay off my loan or sell it and pay off my loan. So the ultimate penalty will be you losing the assets if you are not able to pay off the loan because financial risk is going against you.
Okay, thank you. Abib, can you speak out your question because I don't think I understand it. So if you're here, can you unmute your mic, Abib, and the one that you spoke on SPV? Okay. Hi, Abib. Okay, can we just like continue until ready? So it said,
says if an can an SPV if an SPV can an SPV issue bond, or if an SPV issue bond, can it be listed on the Nigerian Stock Exchange if the project is viable?
Yeah, so for SPV to issue a bond, you can do that as long as you have already bring the project. So normally when the project is at construction stage, it's very risky. There is no cash flows. So investors are not willing to take that risk. That's what project finance comes in. So the project finance, these are lenders who have devoted themselves to finance projects. So they normally take the initial risk. But when these lenders gives you the money, after the project has come to life, is now operating as a company, you can now list a bond on the stock exchange, and the proceeds you get from that bond, you can use to pay off the initial lenders. And now you'll be a public listed company in terms of bond. And you'll be servicing the bond to the general public right from there. So the best practice is initially you get lenders who finance projects. Then after that, you can list a bond. When the project is now operating, you can now list a bond and the public now buys the bond because you are now an operating company, just like any other company. Then use the proceeds of the bond to now go and pay these lenders. Because normally, bonds interest rate is lower than the initial interest rates the lenders were charging you. So it's like you are refinancing the debt. But initially, if you are starting a project fresh, it's not operating company. So I don't even think the stock exchange will even list you on the market. So the best practice, and from experience, what I saw from my work experience is that initially you take debts from these project financiers, then you put on the project. Then when the project comes to life, you now list a bond on the market and use the proceeds to pay off the initial project financiers.
Thank you. So thank you for that. So someone also says, please can you help clarify the difference between project finance and structured finance?
Yeah, so structured finance is mainly about securitization. So mainly it's about asset-backed securities. Like for example, the bank gives a loan to someone to buy a house, a mortgage. Then instead of the loan sitting on the bank's books, the bank will now set up an SPV, then offload these loans to that SPV. Then the SPV will now sell these loans to the general public. So the difference between these two is that project finance, from the scratch, they are with you. You build the project together, they put their money in and expect their returns from this project. But structured finance is an asset which is already generating cash flows. Then instead of you waiting to get your money from these assets, you now take off this loan from your books and structure it into tiers. So we call it tranches. So the first tranche, they will get lower returns, but they are taking lower risk because out of these cash flows, they buy the most comfortable ones. So if the cash flow is coming in, the class, let me say class A people will get first paid. Then those who bought the second, which is class B, then so it goes on and on and on. So if you are at the bottom of the tranche, you get paid last, but you get higher return. So it's like you are taking higher risk for higher return. So structured finance is what you normally call securitization. That's taking cash flows of existing asset generating cash flows. So asset generating cash flows and structuring that cash flows and selling off to the market. And you will take the money up front now. Then the market will now be receiving the cash flows from the asset generating the cash flows. So it's different from project finance where the lender start from scratch with the equity investor and they all build the project. And so, for example, if after the project comes to life and this lender now don't want to wait and take the money every period, this lender can now also go, depending on the agreement they had with the equity investor, this lender can also now go and structure its debt it has in the company and sell it off in the structured finance market.
Yeah, thank you. So someone says, how is the SPV registered? Is it the way corporate companies are also registered with the CAC, like Corporate Affairs Commission?
Yeah, same way. You register it as a company, depending on the jurisdiction you find yourself in.
Okay.
So in Africa, you normally register it as a company.
CAC.
Then
Okay.
So it's just like a normal company, just that it has a purpose that is coming to execute.
So another person says, what regulations are in place to prevent corporate firms from misusing SPV?
Yeah, so that's why the lenders do a lot of due diligence. So even after giving you the loan, they also comes in regularly to check that what's the stage of the asset you are developing, the project, where is it now? And they don't, the money, when they are giving you the money, you need to give them your budget that you are going to buy this. And they will make sure that you have a, so if you say you are going to buy maybe turbines, if you are putting up a gas power plant, they'll make sure you have invoice from the supplier. And even at some case, they will just pass by you to go to the supplier to verify that this is an invoice coming from them. So they put in a lot of due diligence. So if you are a financial institution and you don't put in a lot of due diligence, that's when somebody can misuse their funds. So the financial institution try to do thorough due diligence and make sure you are using the money for the purpose the money was given to you for, so that you don't misuse it.
Yeah. So another question, can the sponsors use its SPV as a collateral?
Yeah, so the SPV is not can, it's a must in project finance. The SPV, which is the project company we've set up, the assets that we are building. So if it is a hostel facility, the hostel facility is a collateral for the loan the lender is giving to you. That's a must. So that's why it's project finance. So in project finance, the assets of the project company is always and always a collateral for the loan. Then even sometimes, if the lenders are not comfortable with that, then you need to bring in what do you call external guarantees. That is the parent company need to step in that if the project's cash flows are not enough, or if the project is unable to pay the loan and we sell the project assets and that asset is not enough to settle my loan, the parent company will come and pay this amount, or maybe pay the top up or pay a percentage of this. So you need a guarantee too. But for the project company asset, it's always a guarantee for the lender, because he's putting 70% into that asset. So no lender will do that without even taking collateral on that asset, because essentially it's like he's the majority owner of the assets for that time his money is in the project.
Okay, thank you. So someone says, can you clarify on the meaning of EPC co? I think EPC
Yeah, so EPC is engineering, procurement, and construct. The co means company. So EPC co, the
Okay.
co just stand for company. That's the short
Mhm.
form. So engineering, procurement, and construction company. So they are the companies that execute the project itself. So if I want to build refinery in Nigeria, the engineering company I'll contract to put up the refinery from ground zero to complete refinery assets is the EPC. They do that. So they will be doing all the construction. If you go to construction site, those there with the helmets, with the vest, they are doing the work. So those are the EPC contractors. So they do the engineering, procurement, and the construction.
Okay, so we have two questions from our YouTube class. It says, one says, when does a company decide to use project finance or corporate finance, and what are the conditions that necessitate them?
Yeah, so project finance is normally used for long-term assets financing. So if I'm
Okay.
building a power plant, I can't use corporate finance, but corporate finance, most of the time, their lifespan is limited. There is a short-term source of financing most of the time. So if I'm building a power plant, which is like 20 years, I need a project finance because those investors are willing to wait. Even those who are not willing to wait, maybe those who invest after 5 years, after that 5 years, I can now refinance it with people who are willing to wait, like institutional investors, like pension funds, high net worth individuals, and those. They also are willing to wait. I can refinance it with them for that 15 years. And another reason is the recourse and non-recourse, because project finance is very risky because it involves huge sums of capital and the lifespan is very long. So as a sponsor, I don't want to use my current balance sheet to finance these long-term assets. What if tomorrow things go bad? The lender will just come and take over my current company balance sheet and look at the assets that can pay them off and sell it and pay their money. But if I use project finance, my obligation is non-recourse, so it's limited to the assets of the project, and any other external guarantee or collateral will also give. So project finance is typically used for long-term assets, which involve huge sums of capital, like building a refinery, building a power plant, building a hostel facilities, building 5-star hotel. Those involve huge sums. So that's what we use project finance for.
Finance for. Okay. So now this is like a follow-up question. It says, so what if after the project completion there is no profit? Will the company still pay tax? Will the company pay tax?
No, so taxes are paid even in normal businesses. Taxes are paid on profits you make. So if a company is not making profits, they don't pay taxes. And that's typically one feature, one characteristics of projects companies. Normally in the initial years, they tend not to make huge profits. Some even make losses in the first 2, 3, 4 years.
Yeah.
So the tax laws, for example, Ghana tax laws like this, the tax law give companies the advantage to move losses forward for some years.
Wow.
So like 3 years or 5 years, you can move the loss you made today for, so that when you make profit that time, use it to settle before you even
Wow.
pay. Yeah, so
Mm,
you
that
only
makes
pay
sense.
tax when you make profits.
Okay. Thank you. So this is the last question from Success. And she says, is it the sponsor that makes the decision to get so many sources of finance, or is
Yeah,
it the financial institution that makes the decision to transfer the risk among several other fellow institutions?
sure. So it's both sides. So that's where the structure and execution comes in. So the sponsor, which is the owner of the company, can propose the structuring they want. So let's say I'm building a project, I'm building a power plant, $100 million in Lagos. Then I sponsor, so I'm putting in $30 million. I need 70 million debt. So this is the structure I want to put in place. Then I go to a lender or I approach a lender, and this lender says, okay, fine, but looking at the risk associated with it and looking at my internal, like, risk adjusted return on capital and my internal other factors, I can put in all the 70 million. So I'm also proposing that let's bring on board this other lender and divide it 35-35 among the two lenders. Or let me bring on another two lenders and make it 30-20-20. If I do that and you, the project company, the sponsor, you are fine with it, then it means the other two people come on board. So sometimes you propose as a project sponsor, but when you approach financiers or lenders, they will also propose based on their internal, because sometimes they can, because something concentration risk and all, they have all those internal things. So sometimes they also come put in that 70 million you want based on some restriction they also have internally. So they can also propose to bring others on board. Sometimes the project company itself can also decide that the 70 million, I want 3 lenders. But mostly the financial institution that try to structure it that way because they are not willing to take on that risk, because sometimes they have those restrictions not to put so huge sums
So
of
much.
money. Yeah.
Yes. So thank you. I think this is actually the end of our Q&A. Yeah. So thank you very much, Mr. Frederick. Can we say thank you? Just like give a round of virtual applause. You can also type in the chat box. Thank you, Mr. Frederick, for the time, the efforts put into this class. It is not easy, you guys. Like I know what top like professionals face. They are very, very busy professionals here, but the fact that he came out, like gave us his time and efforts into even making the slides stuff. It's really an honor, and we did not take it for granted. And so we say thank you, Mr. Frederick, for honoring us, for honoring our invite to YFL 3.0. So yeah, this is actually the end of the project finance class. Thank you. Thank you very
Yeah,
much. Mr.
sure.
Testimony
It's my
and
pleasure. And thank you everyone for your engagement. I really appreciate it.
yeah, Testimony, your hands are up. You want to say something?
Yeah, thank you very much, Frederick. And for those who don't know, Frederick is the future Minister of Finance in Ghana. So if you want to stay in touch, you might want to stay in touch. Frederick, thank you very much. He's one of the top guys on Wall Street now. So stay in touch. And it was really a very, very great class. Project finance is something that is not just important today, but very important for Africa. I think there was a question about where project finance can be done in Nigeria. Just to add to that, there are a couple of companies that I don't think we have any pure project finance company in Africa or in Nigeria specifically, apart from AFC. But I think some banks actually like finance projects, so they have internal project finance teams. Then private equity companies, I know Berod, they probably they do some project financing transactions. I'm not very certain, but usually the people that do this thing mostly are banks and PE companies in Nigeria. So you can just research them. People that have a lot of money to invest, they do project financing a lot. Then there is this other company, though it's a private equity company, but most of their investment is like project financing company. Long story short is if you know people that have a lot of money, like fund managers in Nigeria, either they call themselves private equity companies or fund managers, they probably project financing. It's just fund allocation. And that's one of them. Then there was another question, I think, that was about how corporates decide between project financing and corporate financing. Yeah,
I think he laid a lot of credence to that. One other thing I wanted to add is corporates typically want to manage their leverage. So because of project finance require a lot of money, they don't want to like over lever their balance sheets. So sometimes they might just take a project finance structure rather than like taking it on their balance sheet because that's for a very long time. And one thing about these project financing structures is that in the beginning, there are some kind of lenders that want to take some risk. So maybe the construction, they come, they construct that project. Then what companies typically do is they just refinance. So you've already reduced the risk in the beginning. So you can get more favorable terms after you've constructed the project. You can now like go and refinance. Refinancing in simple terms essentially means you go and collect another loan in a different interest rate. You pay back the existing loan and then you increase the tenor, like the term that you're going to pay back this new loan for. That's essentially what it means. So that's typically, I think that's typically one of the contributions I wanted to make. So guys, if you have any questions after the session, please reach out to Frederick. You can connect with him on LinkedIn. You can also drop in the chat.
Yeah.
It's very, very welcoming and everything. Thank you very much, Frederick, for like providing your knowledge and wisdom. And we look forward to seeing you as finance minister in Ghana.
Thank you.
Thank you. Yeah, thank you, Mr. Frederick, once again. And thank you everyone for joining. YFL continues tomorrow. So see you guys. Thank you.
Thank you.
Yeah, and also I'll be dropping Mr. Frederick's LinkedIn profile on the group chat. So do have to follow him on LinkedIn. Yeah, I tell you, build connections on LinkedIn. This is the perfect time to actually build your brand and build connections, meet people, meet all those professionals. They're humans. If you send them chats, they'll answer you. They'll might not be immediately because they're busy here, but they'll answer you. So thank you everybody once again. See you tomorrow, same time, same station. Bye.
Bye.
Thank you. Bye. Yeah, you can log out. I just do my task.
Bye bye.
Yeah, bye everyone. You can actually log out. I just have to do some like finishing touches on like the recording and like so. Yeah, that's why I'm still here.
Okay. Yeah, well done. Bye bye.